Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. I have previously highlighted here two patterns that are currently running all that is going on here in this market. Both are bearish. The first is highlighted in dark blue on my daily chart and is the early November 2022 to February 2023 bearish Andrews pitchfork. The market has mainly been between the upper time, currently at 608, and the middle time below, currently at 545. The upper time has been breached on many occasions, most notably at the end of last week, and we are on the verge of my saying it is a broken pitchfork, but not just yet. And the reason is to do with the second bearish pattern here. This is a newer pattern, a bear channel, currently 563 to 643 for the February to date action, and is highlighted in bright red on my daily chart. The upper bear channel line had been especially significant until about late May. You see, the upper bear channel line had been in lockstep with the declining short medium moving average, currently at 657. Between late March until late May, when then the short medium moving average separated from the bear channel line with a less acute but still bearish angle lower. This reduced their combined strength, though they are still in close proximity to each other, and as we can have seen this week, they do still work together as an effective bearish capping screen. In addition, we currently have the neckline of the small but influential October to November 2020, currently at 646, and this sits in between those two resistances. There's not been a great resistance, as you can see back in May, but it is still there and may have filled in the void that the separating moving average and the trend line left behind. This doesn't mean the market has not fully followed through higher, but is still pressing up against the overhead resistances. So where does that leave us? Well, further up beyond the short medium moving average, we next have the very interesting 50% absolute Fibonacci line at 682. This had been effective if breached support back in March and April, and just above that is the January 2021 high at 693. This is an interesting resistance right now, as it has the medium moving average, currently at 692, dropping down through it. However, at its present rate of descent, it will reinforce the 50% absolute Fibonacci line by the end of next week, and the beginning of the week thereafter, or thereabouts. So that will then in turn become interesting. Meanwhile, with respect to the downside, well, the July 2021 low at 609 has held up the market for the most part, though throughout May, though the downward pressure of the upper time means that we are now seeing one of these give way. This also applies to downward pressure from the upper bear channel, which will cross over the July 2021 low by early July. So at the moment, despite the current move over the upper time, the July low still looks vulnerable. Below this, we have the previously mentioned March 2021 low at 592, and beyond that, we have the lower bull channel line and the middle time, currently at 545, along with the December 2020 low at 566. Chicago corn. The obvious feature here is still the huge gapping move lower made 4 weeks ago. The market was led lower prior to this gapping move down by earlier bearish patterns in action, and of these, the one that still stands out is the monthly key reversal down made in April. This monthly key reversal down was finally enough to set prices moving even lower. The gapping action went straight down through the 50% Fibonacci line of the April 2020 to April 22 move at 567, the July 2013 high at 564, the 2022 low at 562, the combination of the 2014 high and 61.8% absolute Fibonacci line at 525, and even the October 2021 low at 516. This showed the sheer power and very effective vehemence of the move lower. There was only congestion between 502 to 491, with the 2021 low at 498 within it that finally halted the decline. So what have we seen since? Well, there is some previous form in this market holding at this 502-491 region, with the 2021 low at 491, which was and still is backed on up by the longer term charts, with the slowly rising 5-year moving average at 501.25. These together started a small recovery since mid-May and attempted the filling in of the changeover gap between 519.5 to 472.75. However, this week prices ran into congestion overhead dating from October 2021 that starts at 539 and moves higher, and this has capped the rise, even allowing the drawing of an upper trendline resistance that is quite acute and up in the 556 area right now. Yet the drop has been limited so far, with yesterday's low being made on the 50% Fibonacci line at 514 of the very recent late May to this week move, and close to the October 2021 low of 516. Now further down below the May low, we have congestion between 469 to 465, then at 449, 444 and 436 to 410, but the next big support is the 50% absolute Fibonacci line at 424, and that is not just below the bottom of my daily chart, but also quite a lot to swallow. So this all leaves a question as to what the recent moves down and then up really mean. Are they becoming a possible bearish halfway hesitation, or is it a possible double bottom in formation? I'm afraid it is still too early to tell. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.